So the institutions, they're not going to do business with just anyone. You need to have a solid business and run a tight ship. But outside of that, they're going to do thorough due diligence, not only on the underlying asset and the property, but your team who's going to be doing the asset management, the property management, combing through your business plan and your assumptions before they make a commitment, put any capital out. That's an ongoing thing post closing. We have monthly reporting requirements that report to them as well as quarterly and annually.
Welcome to the Wild West Real Estate Podcast. And now, here's your host, Mark Hinteman. Today's guests are the co-founders and managing partners of the Equity Yield Group, an investment firm focused on institutional grade value add A and B class multifamily with 180 million in assets under management. I'd like to welcome Warren Dresner and Ryan Webster.
Hey, Mark. Thanks for having us.
Hi.
Thanks for joining. Bright and early. It's not bright and early over by you guys.
No, late morning on the East Coast, but I know it's very early for you.
Yes, slightly uncharacteristically early, which is why I'm tongue-tied. Anyway, so yeah, let's dig in. How did you guys meet?
So we were both, I guess, part of the same group, trying to find deals, searching, like doing a lot of underwriting, working on the acquisition side, trying to find multifamily deals. I was looking in Florida. I live in Florida, and Florida was my home market. And Ryan was also looking in the area. So we actually found out that we were looking at the same deals and started to talk and compare notes. And then from that moment on, started to kind of work together and form a partnership.
Oh, nice. Were you part of like a boot camp, or what was the organization? Do you guys want to mention?
We had joined a mentoring group called Think Multifamily out of Dallas.
Multifamily. Okay. Yeah. Okay. Yeah, I'm familiar. I see that a lot. I don't know. I'm not that familiar with it, but I know I see that name a lot.
Yeah, absolutely. No, it's a good group. I mean, it's a great way of getting into the industry because there are some big barriers to entry. And joining one of those groups, you've got a ready-made network. You can work side by side with like-minded people. You get the education, which is valuable as well.
Sure.
So it's actually pretty cool. Yeah.
Pardon me. Go ahead.
No, it's actually a pretty cool way for people to get into the industry. And I think that's why we've seen such a growth in that part of, the syndication world over the last couple of years.
Right. Because people are getting trained, going through those boot camps or whatever they are, the educational platforms.
Absolutely.
Prepare them and then unleash them out into the world.
Exactly. Which can be, it can be dangerous as well. But I mean, it's definitely of benefit to lots of people who want to get into the industry.
Yeah, it's better than, when I started back in like 99. Yeah, I was not aware. None of that was on my radar. Some of it might have existed, but you just had to read a couple books and then jump in.
Right.
How about a little bit about where were you guys separately before that? What were you doing that made you want to pivot?
You want to go? You go first, Ryan.
And then I'll jump in. So kind of prior to transitioning into this, value add, multifamily, stabilized asset space, I owned and operated a construction development company for a good number of years. So always been in real estate for most of my career, but was just kind of on the other side of things. As I was, I built this company and it was pretty successful, a large company, but my kids started growing up and I was looking at them like, we're not too many years away before they don't want to hang out with me anymore. So I was spending a lot of time, working in this company that I had built. So I kind of took a step back and looked at it and figured out, what do I really want my life to look like over the next few years, and kind of figured out that, running that company wasn't going to be sustainable with, my life and family goals. So then kind of looked at, okay, well, how can I shift things up? And, started looking at, long-term rentals and listening to Bigger Pockets, which I think is, the gateway drug into real estate for many of us.
Seems to be.
Figured out, if you have rental income, you have income coming in all the time, you're not working as hard. And then there's the tax benefits on the development side. You're building and you're selling and you're paying capital gains all the time. So it was kind of a logical transition into a similar space where I was.
Absolutely. Oh, cool. How about you, Warren?
So my background's a little different, I guess. I'm from Australia originally. I kind of been in the corporate world, or I was in the corporate world 22 years. Kind of had the background of I was told to work hard, study hard, get a good degree, go and get a stable job. And I did all that. And I was successful at it. I had a great job, traveled around the world. But probably when I got to the age of about 40, I realized I'm actually trapped. Like I've got a great income and a great life, but if I ever wanted to leave, I've got no other income. And so from that point onwards, I started to think a lot more about building passive income. So I started investing in real estate, I started investing in syndications as a passive investor, and then slowly over time, wanted to get more active. And so that was
Sure.
my path. I think traditional path for a lot of people, going and getting that advice about go and get a good job and just work until retirement. But at some point in time, it just clicked that that is not what I wanted to do.
Yeah, it sounds like you both independently came to the same conclusion that you didn't want to pursue the standard path that's pretty
Exactly.
much set out culturally for all of us.
Absolutely.
That's great. And then you guys met at Think Multifamily and then jumped in. How did that work?
So I think what we found was we both have similar philosophies to what makes a good investment. Not everyone in that group or in the industry thinks the same. You know, everyone's got a different criteria and they go after a different part of the market. But for both Ryan and for me, we were always very conscious of risk and returns and making sure the trade-off was correctly positioned. With Ryan's construction background, he was quite averse to older properties and potentially deferred maintenance and construction issues that might come about and cause risk. From my background in finance and insurance, I was more concerned about the numbers and I guess different things that could go wrong, skew the results in the wrong way from a financial point of view. So we found, like, the more that we started working together, we found that we were looking for the same kind of deals. We wanted to buy in strong markets where the waves were pushing us in the right direction, not working against us. We wanted to buy newer assets where we didn't have the risk from the construction side or deferred maintenance side. So we were kind of focusing on the same types of assets, and that seemed to work really well, and it fitted great for us to start to work together.
That's great. Similar to the way I approach, I feel like I'm an outlier in that I focus on the market and focus on strong markets. And often, it comes with a price. It's more expensive and lower cash flow, but it's a risk. You're hedging your risks and you're playing the fundamentals of the market and the momentum of the market. I always tell people, like, yeah, we invest in growth momentum and we find locations that have growth momentum that we can ride and they could forgive our mistakes.
Absolutely. I mean, first and foremost, we pick the market. We're value add investors, so we want to be able to add value ourselves as well. But we want to ride the wave of the market. We want those tailwinds because that's just going to make our job easier, right?
Yeah, I think that's smart and somewhat unique. It seems a lot of people, maybe they've devoured the Robert Kiyosaki sort of philosophy, and it changes the way you approach real estate.
Yeah. Well, and the thing about, multifamily is, yeah, you have an underlying hard asset. You have the land, you have the buildings and the structure, but that's not really what you're investing in. With multifamily, you have scale and you're investing in the underlying business within those buildings and on that asset. And you're investing in the income in that business and the growth potential of that income. And that's why it's so important to start with, the market and the demographics, because that's what feeds the business.
Right. And what do you look at? I mean, some of the factors, are population growth, rent growth, supply. What is your criteria that you cite when you look for a great market?
Yeah, I mean, if the first kind of categories feed into supply and demand, you need demand pressure, you need growing population influx of tenants, people looking for housing. We look for areas that are supply constrained or have high barriers of entry for new supply that's going to help support price points. But then, when we're talking about growth potential, especially in growth in rents and in value add, you really got to take a close look at incomes, and can the incomes and the job of the area support the growth that you're looking for in your business model?
What are the factors that contribute to constrained supply?
So if you look at, like, Phoenix is a good example, it's expensive to build, but there's very limited buildable land. Most of what's can be built out is built out, unless you want to kind of go up the mountainside, which is even more cost prohibitive to build. And the rest of it's protected land federally that you can't build on. So there's that. And then like zoning, if you get into areas where you have zoning requirements, are very hard to get rezoned or get approved. Those can be very high barrier entries to new supply.
Sure. Those are great. Yeah. Legislation as well, the legislative environment.
Yeah, absolutely. But then, it's a very, very tight region you're looking at. So your property, you don't care if they're building something clear across the side of town. It's, that immediate area, what is going to be your immediate competition.
And you must have become somewhat expert in that as a developer, being in the development world, as you got to deal with all that.
Yeah, because I've spent most of my career on the other side of looking, okay, where can we build? Where is it cost effective to build?
Right.
And new products very expensive to build. So you need an area that you can prove out rents that are going to justify, not only the expense to build, but the risk of putting up a new building, because the risk reward on the development side is a little bit different. If you're going to, put it out there and take that risk, you want a much higher return.
Right. That's great. So which markets did you guys decide on, or how did you come to a decision on where to invest, and where did you ultimately invest?
So, I guess by state, we broke it down to Florida, Carolinas, and Texas. That was
Okay.
the starting point. Where we found most success in the last couple of years was in Florida, and in
Florida.
particular on the West Coast, so around Tampa and south of Tampa.
Okay.
And those kind of fit the bill. We saw, in retrospect, with the benefit of hindsight, Florida's been great. The last 2 years, there's been such an influx of people to the state. So population growth has been huge. Rent growth has been insane.
Right.
30, 40, 50% rent growth, which we don't think is sustainable at all. We've benefited from it. It's been great for our properties. They've performed really strongly. But at some point, we feel like there's going to be an affordability issue. So that's another factor that we've got to keep an eye on, because like Ryan kind of mentioned, job growth is important, and we need to make sure that wages are high enough to afford the salaries. So I'm not sure that the people living in our apartment communities are going to be able to withstand another 10, 20, 30% rent growth. It might be new tenants in there, but that's something that we watch quite closely as operators.
Okay. And Warren, you're in Florida. Are you close to Tampa?
Yeah, it's about a 3-hour drive.
Okay. So you can get to it pretty easily. Is that where you began investing?
In multifamily, on the active side, yes.
Okay.
Yeah.
Like as your partnership, what did your first deal look like?
So our first deal together was in Sarasota, which is about 45 minutes, an hour south of Tampa. It was a $26 million deal, 148 units. It's actually an A-class deal, built in 2016, but it was unique because although it was new and it looked great from the outside, the insides were not very pretty. The kitchens seemed to be put together quite cheaply, and there was definitely an opportunity to add some value on the interiors.
I see. So despite being a new product, you had opportunity to add value?
Absolutely.
Was it with upgrades, or was it the rent?
It was with upgrades predominantly. So the kitchen, these ugly dark brown faces on the cupboards. The appliances were pretty old. I think the color scheme was just awful, so we dropped new.
Poor choices.
Poor choice. I guess it's just cheap choices, really. The guys
they cheaped out.
Exactly.
I see. How did you guys raise? That's a lot. That's a big raise for your first deal, 26 million.
Yeah. So, it kind of gets back to the criteria. As we talked about a few moments ago, we wanted to buy in great markets and we wanted to buy newer assets. So we knew in advance it was going to be a big equity raise to take down one of those buildings. So we were very intentional early on in building relationships with private equity companies, institutional capital. So our strategy from the very beginning was to build relationships on the institutional side and also find other groups who are like-minded, who are willing to partner with us. So we went into this knowing that we had a couple of sources of equity. We weren't going to raise all the money ourselves. And we started working with the institutional groups well in advance of winning that deal. So we probably spent 12 months underwriting deals, talking to these guys, building the relationship. And I think that was really beneficial, both from our point of view and from their point of view.
Building confidence in their eyes.
Absolutely. So by the time we did win this deal, we had a good relationship with one group, and they ended up putting, I think it was just under $7 million into the deal.
Oh, great. Great. Yeah. And, that's fascinating getting into institutional capital and doing so quickly. What we do a little bit of that and had a little bit of success, but obviously it's like the white whale of syndication. A lot of people hear about it, but they don't know much about it or how to get into it. You said you built those relationships, and you mentioned private equity. Yeah, what types of firms were these that you were approaching?
Yeah, so they're institutional private equity funds. The one we did on this deal, they're a subsidiary of a REIT, and they just place third party preferred equity and hybrid preferred equity slugs into deals, just kind of filling out the rest of their REIT allocation.
Oh, cool. And yeah, I'm sure when you get into institutional, can you speak to a little bit of the process and the hurdles and the requirements that they must have? Because you're not working with some 30-year-old who wants to invest passively. You're working with a team of experts on their end that are gonna just turn over every stone, and they want to make sure that their money is safe.
Yeah, and I mean that's kind of the first thing is, if when you're buying, multi-million dollar multifamily and you're looking in this, major market, 100 unit plus space, it's not a hobby at that point. You need to be professional and you need to run a business and be organized. So the institutions, they're not going to do business with just anyone. You'd need to have, a solid business and run a tight ship. But outside of that, they're going to do thorough due diligence, very similar to the due diligence that the lender performs, not only on, the underlying asset and the property, but your team, who's going to be doing the asset management, the property management, combing through your business plan and your assumptions before they make a commitment to put any capital out. And then that's an ongoing thing, post closing. We have monthly reporting requirements that report to them as well as quarterly and annually.
Are there any interesting things that they required? Like, how big is your team? And I was wondering, do they scrutinize, like, do they want to see a succession plan in case one of you gets taken out somehow with sickness, illness, or God forbid, death? Do they want to see your team to be at like a critical in terms of what you've got in your organization, or are they fine and comfortable going with a small?
I think it's really about who's running, the day-to-day on the asset management, both the property management team. This particular company, they own a property management firm. So we have a sub-management agreement. Our property manager runs the day-to-day, but their property manager holds the contract over that. So if there were any issues, their property manager can step in and it's already pre-approved by the lender.
Okay, so they have a fallback.
Yep.
Great. And with that first deal, yeah, did you raise 26 million, or it was just a $26 million deal?
It's 26 million purchase price. I think we had to raise about 11. So we
11
got
million.
around
Okay.
7 on the institutional side, and then we raised 4 million between us and a couple of partners. We raised the rest.
Okay, that was my question. So the institutional investor invested the bulk of it, and then you filled out the rest with some just private individuals.
Exactly.
Oh, nice.
The way we look at it is it's a tool in our toolkit. Like, it's great to have some relationships and potentially have access to capital there, but there are advantages and disadvantages of it. So like you mentioned, they're going to scrutinize the deal. They're going to have provisions where they can step in and take over management if things don't go well. It's not going to be right for every situation. So from our point of view, we want to have access to that capital. We want to be able to raise capital ourselves, maybe partner with other people who can raise private capital. And then on a deal by deal basis, we'll evaluate which is the best source of capital for this particular deal.
Did you find that they negotiated with you and I know we've had like family offices and some smaller private equity firms, and they always come with some requests. Hey, if we're going to put in this big amount, could you improve the returns for us?
No, this particular one, so it was a preferred equity investment. which is, one of the reasons we use institutional capital is to, source more efficient capital at a lower cost than what we'd raise from our retail investors. So yeah, there wasn't really a negotiating point on returns. Their whole, thought process is they're going to place capital, they're going to place it in a lower risk position, and the trade-off is that's going to be cheaper capital for us.
Okay. Oh, great. And how long ago did you buy that property in Tampa?
That closed March 2021. So it was about 18 months ago, I guess.
Okay.
Right.
Okay, great. And where did you go from there?
Soon after that, so that one we got under contract actually back in 2020, but we closed in March. We then had another deal in Bradenton, Florida, and then another deal in Bradenton as well. So they were the three that we closed in 2021.
Okay. Okay. What size deals were those? Were those similar?
All kind of similar. So the second one, 166 units. The third one was 216 units. So the second deal was a little bit older. It was 1986, 87 construction. So more of a B-class deal, but it was in a nice little pocket of the submarket. And then the third deal was another A-class deal.
Okay. So that's your tier of the market.
Yeah. I mean, we definitely, I guess the ideal property for us would be something built around the year 2000. It's new construction, but it's probably 20 years on. It's getting ready for its first facelift. So there is some value to be added. That would be, in a strong market, something built around the year 2000 would be an ideal one for us.
Sure. What are you doing now in terms of acquisitions? Are you slowing down, or what's your thoughts on the market?
I can give my thoughts, and then maybe Ryan will have some of his own. We're looking to acquire. I mean, we're out there underwriting deals. We're very focused on the risk, and the big risk that we see at the moment is interest rates. The whole year we've known that interest rates are on the up, and so we've been underwriting conservatively for that. If we're looking at bridge debt with variable interest rates, we're underwriting for that and taking into account the fact that they're probably going to go up over time. And in that scenario, we're underwriting for the fact that we're going to have to refi out of them, and it might be a challenging time to refi in the next 12 to 36 months. So we've been kind of conservative on a lot of those assumptions. And as a result, we're not winning many deals. We feel like there are other people who are more aggressive than us at the moment.
Right.
Having said that, the last month or two, we've started to see a bit more opportunity out there. Prices have come down a little bit. It seems like there are less buyers out there. So we are seeing some opportunities at the moment. So we're actively looking, but it's been kind of slow the first half of the year.
Sure. Yeah, that sounds comparable to my experience. What are your thoughts? How do you handle debt? I know, we're in acquisition mode as well, but it's a little bit of sticker shock when we were used to 3.2% interest rates, and now we're looking at 5.
Yeah, we've been looking at, a lot of fixed rate debt lately, bank and agency, and it is lower leverage. Most we look at is right around 55% LTV on the loan. So you're having to raise a lot more equity than you would 12 months ago for the same deal. But given, the cost of rate caps has skyrocketed as the forward curve has gone up. So you can't really afford to hedge the interest rate risk on these variable rate products anymore. And, last year, so that deal we bought, that first deal in Sarasota, we did a Freddie variable rate loan on that. And we bought a 50 basis points rate cap to hedge that risk because we knew at some point interest rates were coming back up, but rate caps were affordable back then. I think we paid $175,000 for that rate cap.
Okay.
We just refinanced that property into fixed rate debt a couple months back. Did a cash out refinance. We're able to pull out a little over $5.5 million in that. But we're also able to sell that rate cap. So we sold that rate cap for $850,000 that we bought for $175,000.
Oh, wow. Can you say that again? What did you sell it for?
$850,000.
Wow. Oh, that's amazing. And that went to the new buyer?
No, we refinanced and
so you
pocketed that.
Ownership of it. You didn't sell.
Yeah.
Okay. Wow. Interesting.
Now, if you're going to go, variable rate debt and have to buy a cap at market rates, it's very easily at multi-million dollars that you're dropping into sources and uses to be able to afford an interest rate cap to hedge that risk.
Right. Yeah, it's tricky times at the moment.
So there's another strategy we're working on at the moment as well. We are actively looking for new deals, but something else that we've worked on over the last few months is creating our own preferred equity fund. So we've been a user of preferred equity in the past do you buy preferred equity where we've sourced it for our deals? But something we want to start doing is offering preferred equity to other operators, because we're not that interested in seeking a 16 or 17% return if we think that there's too much risk in the deal. But if we can sit in a lower risk position, say above the senior debt, but before the common equity holders, we're happy to take an 11% or a 12% return. So we're putting together a fund where we have the ability to offer operators smaller check sizes of preferred equity.
Okay. That's interesting. Yeah, that's really interesting.
Yeah, and back to kind of the market conditions, when you look at it's really about the rate of change. Anytime there's a shift in a market, it's about how fast is it changing, how much is it changing. And we've seen interest rates change very quickly and move a lot in the last 12 months. And that's caused a lot of price discovery to go on in the market, which is going to translate into opportunities. There's going to be some good buys out there, but in this kind of middle term, while we're waiting for the dust to settle, there's going to be some assets that trade at a basis that doesn't quite make sense, that wasn't adjusted enough for the new interest rate environment. So when you talk about the common equity position and taking that last dollar risk, and like Warren said, if getting a 15, 16 IRR, that's great, but how much risk are you taking on to generate that? And what's the probability of actually hitting it? So if our last dollar is sitting at, a 60 to 70% loan to value position, and, we're looking at a 12% return, it's a lot lower risk position, a lot more certainty of hitting that 12% while we kind of wait for the dust to settle here and figure out where cap rates are going to be in the near future, where stabilized interest rates are going to be.
Yeah, that's a great point. Yes, we are at quite a kind of a mysterious point in the market. I remember, I went through 08 and the .com crash, which didn't feel like it was that much of an impact in multifamily, but certainly the 08 downturn was cataclysmic.
Mm-hmm.
We'll see where we go with this one. It doesn't seem like we have the same issues, but yeah, interest rates and how they impact the economy is going to be, the determiner of what happens.
Yeah. Well, fundamentally, multifamily is still a great asset class. We've still got a shortage of housing in the country. So there's a need for the product. I think it just comes down to a pricing issue.
Right. Pricing has to correct it. To your point, yes, builders were very slow to recover after 08, and they still haven't caught up in creating supply. And then combine that with supply chain issues and material shortages, and most markets are not oversaturated with supply. A couple of them are, and some of them are, but it sounds like you guys analyze a lot of metrics of the marketplace, and I think that's an important one, because there are markets in cities out there that have too much supply now, and there's others that are still behind the ball.
Absolutely. And then you add to that, the interest rates, the new permits are significantly down as developers are kind of pumping the brakes here because their cost of capital is going up to build.
Yeah, that's a great point. Yeah. Well, this is great. Are you guys ready for the question round?
Absolutely. Let's go for it.
The book you've recommended most over the past year?
There are probably two. One is The Great Rat Race Escape by MJ DeMarco.
Okay. I haven't heard of that one.
But one that I read recently, which was great, was The Psychology of Money.
Right. That's I like that book.
That was excellent.
Yeah. For me, it's still cash flow quadrant. That one's near and dear to me. And I didn't really spend a lot of space in the E quadrant. I kind of jumped into the S quadrant early on, and then figured out the pain points of that and said, okay, I got to scale and build a business from there. And then moved over into the I quadrant and kind of went through that whole path, and had, I figured a lot of those things out earlier, would have been a lot more comfortable position in my life a lot sooner.
Hey, a question I was going to ask you, but what does your team look like at this point?
Yeah, so we've got Warren and I, and then we've got an analyst, and then we've got a bookkeeper and some administrative help, and then a pretty extensive third-party team. We've got a great relationship with our third-party manager, and they've got a a ton of support staff in their overhead that does a lot of work for us as far as on the acquisition side and performing comp surveys, touring neighborhoods, touring comps, putting together construction estimates. And then there's, the legal and accounting team as well.
Sure. Is your third party property management, is that a Tampa based company?
They're based out of Austin,
They're
but
Austin. Okay.
they have significant presence in Florida. I mean, the thing I really like about them is they used to be owner operators. So post 2008, they formed a fund, went out and bought about $1 billion worth of real estate. As they scaled, they vertically integrated, formed a management company to manage their owned assets. Since have sold off their owned assets and transitioned as the third party. So they have a good idea of what we need from them as owner operators, because it wasn't too long ago that they were in that position themselves.
Sure. So they understand it.
Yeah.
Awesome. What was your favorite movie when you were 15?
For me, it was probably Back to the Future 2.
Back to the Future 2?
One of the great sequels.
I barely remember Back to the Future 2, but I know
That was the one where they go to the future.
So that's right. The cowboy, the West, the Old West.
That was number 3. The Old West
that was number 3. I got them all confused.
Exactly.
I just showed my kids the original Back to the Future. They love it.
I've been trying to get my kids into those movies as well.
Oh, they're great. And I just saw DeLorean's actually making cars again. They came
You're
out with an
kidding me.
electric car they're going to launch, I think, next year.
DeLorean, yeah. You guys aren't old enough to remember when John DeLorean got busted for cocaine?
No. I've seen the documentary though.
Okay.
That was a whole interesting thing there.
I don't know any of the specifics, but I remember that was in the news a lot when I was in like 8th grade.
How funny.
Aside from real estate, one thing you could spend all day talking about.
Probably food.
Food, all right.
I do like food. Yeah, I don't know. Lately, been into wake surfing. Anytime I make it out to the coast, I love to go out and surf the waves. But here in the Midwest, there's not much. So a few years ago, I went and bought a wake surfing boat and been enjoying that quite a bit.
Oh, nice. Yeah. Getting to the water is always great. What was your most awkward?
I would guess it's got to be something like middle school, 7th grade, I'm guessing. I probably blocked out a lot of the memories, but it's got to be around that.
Blocked it out, yeah.
Yeah, it's probably, I don't know, 3rd grade.
3rd grade?
Yeah,
all right.
I was a little shit of a kid and you couldn't tell me anything.
Is that right? Cool. What's your most impressive, totally useless skill?
No, I'm pretty good at close-up magic.
Close-up magic?
Yeah.
Do you perform?
No. Just for the kids.
Just for the kids, okay.
Yeah, I don't know. I'm sure I've got some skills. Some of them might be bordering on useless, but I guess I've got some use.
Yeah, all your skills have high utility.
Yeah, maybe not high utility, but hopefully they got some utility.
Is there a high school friend you'd like to say hello to?
For me, I'm very far from all my high school friends, so yeah, I'd say hello to all of them, I guess.
All right. How about you, Ryan?
Oh, no, not anyone I can think of.
No, blocking out high school. Oh, let's see. And finally, when are you happiest?
I got to say, on a weekend when I'm hanging out with the family. I've got 3 little girls and a wife. And so when we're out having a good time with them, that's probably got to be the happiest moment.
Oh, cool. How old are they? I have 3 girls.
Ah, cool. They are 12, 8, and 7.
Oh, nice.
How old are yours?
Mine are, I have twins who are 14 and an 18-year-old. Just dropped her off at college.
So we're almost getting into that teenage phase, which I'm not looking forward to.
Yeah.
Good luck to both of you.
Right. No kidding. And finally, where can listeners reach out to you?
Best place would be to head to our website, which is equityyieldgroup.com. You can jump on there, see what we're up to, sign up to our list, and keep in touch that way.
Awesome. Well, this has been great. It was fun to dig into a unique strata of the market that you guys are in and exploring the institutional capital. And congrats on your success.
Awesome. Thanks a lot. Thanks for
being on the show.
Yeah, thank you.
Bye.
All right, cool. Bye. Thank you for joining us for the Wild West Real Estate Show. If you like what we're attempting to do here, please subscribe so we can continue sharing these with you. And if you want to check out our website, it's quantumcapitalinc.com. You'll find podcast episodes as well as multifamily properties we're looking at and how you could potentially participate. Look forward to seeing you guys soon on the Wild West Real Estate Show.